This is Bid and Ask, and today we answer a foundational question. What is a futures contract? A futures contract is a legally binding agreement to buy or sell a standardized asset at a predetermined price on a future date. That is the core idea, but to truly understand it, you need to know its key components. First, the underlying asset. This is the market or product the contract is based on. It could be gold, crude oil, agricultural products, or an index like the E-mini S&P 500. Second, the contract size. This tells you the exact quantity controlled by one contract. And this matters because size directly affects your exposure and your risk. Third, the expiration date. Every futures contract has a deadline. It does not exist forever. It is designed around a specific future period. Fourth, the tick size. This is the minimum price movement the contract can make. And in futures trading, understanding tick size is essential because it determines how price movement translates into profit or loss. Finally, there is settlement. This is how the contract is resolved at expiration. In some markets, settlement is done in cash. In others, it may involve physical delivery. Now, here is why futures contracts are powerful. They are standardized. They are traded on regulated exchanges, such as CME Group. And they are backed by a clearinghouse, which helps reduce counterparty risk and brings structure to the market. So when you look at a futures contract, you are not just looking at a trade. You are looking at a structured market agreement with defined rules, defined size, defined price increments, and defined timing. At Bid and Ask, we believe understanding must come before execution. Because once you understand the contract, you stop seeing the market as random, and you start seeing it as a system. Clarity, discipline, control,